Imagine a world where money moves instantly across borders. No bank delays, no fees, no bureaucracy. That's the promise of stablecoins. They're marketed as digital dollars. Fast, reliable, stable. But what if that promise is only half true? What if the very tools meant to modernize finance could also destabilize it? Over the past year, Tether, the largest stablecoin, has surged 46%, hitting $174 billion. The US even passed the Genius Act, giving these digital tokens a regulatory home. Financial giants like PayPal and Coinbase are now issuing their own versions. Even a venture linked to Donald Trump's family launched one called USD1. At first glance, this seems like progress. Stablecoins are pegged to real assets like the US dollar, aiming to fix early cryptocurrencies' wild volatility. They promise faster payments, cheaper transfers, and financial innovation. But as Nobel Prize-winning economist Jean Tirole warns, not everything labeled stable is safe. Behind the promise lies fragility, and history may be repeating itself. To grasp the problem, we need to revisit the first wave of crypto. Back then, Bitcoin was sold as financial freedom, a currency beyond governments and banks. Its supporters were a mix of idealists, libertarians, and opportunists. Yet Bitcoin's volatility made it impractical for everyday payments. It turned into a digital asset for gambling, not spending. Stablecoins were meant to solve that, pegging value one-to-one to the dollar. In theory, each token would be backed by real reserves, cash, bank deposits, or US treasuries. In practice, that backing is murky at best. Take Tether, which has faced fines for misrepresenting its reserves. Auditors have never fully verified that every token is genuinely backed. Another issuer, Circle, had 8% of its reserves frozen when Silicon Valley Bank collapsed in 2023. They were saved only because the government bailed out uninsured deposits. Now imagine millions of users demanding withdrawals all at once. A single doubt or rumor could trigger a run, just like in 2008 when safe money market funds broke the buck. Jean Tirole draws a clear parallel. Stablecoins mimic safety but lack the structure to guarantee it. They act like shadow banks, taking deposits, investing for profit, yet not bound by capital rules or deposit insurance. If they collapse, governments may feel pressured to rescue holders to prevent wider contagion. That's the real danger: private profit backed by public risk. The Genius Act tries to address this, mandating audits and redemption policies. But its language remains vague, allowing one company to issue stablecoins while another promotes them. This means platforms like PayPal or Coinbase can reward users, take risks, and profit without being regulated as banks, a loophole big enough for billions to flow through. History shows what happens next. When safe assets promise higher yields, institutions chase risk disguised as stability. That's what triggered the 2008 subprime crisis, and it could happen again in digital form. This isn't just about finance, it's deeply political. The Trump administration, which backed the Genius Act, has strong ties to crypto. By promoting stablecoins, Washington is boosting global demand for dollars. Every new token tied to a US asset strengthens America's monetary power. But lighter regulations in the US put pressure on other countries. Europe worries about being labeled protectionist if they tighten rules. The EU's tech regulations have already been seen as anti-American. A crackdown on dollar-based stablecoins could face similar backlash. Developing nations risk depending on US-backed digital money, losing financial sovereignty. If a global payment network relies on private American tokens, who controls it in a crisis? Jean Tirole warns us, We can't outsource our payment system to speculative ventures. Money isn't just a product, it's essential infrastructure, and that infrastructure should be public. The need for stablecoins is real. We need faster, cheaper, borderless payment systems. But those features don't need private speculation to exist. Countries like Brazil and China have digital payment systems that work without crypto. The European Central Bank is working on a digital euro, combining trust with technology. Tyrrell suggests public infrastructure should provide the framework for innovation. Imagine a digital highway maintained by the state, where fintechs can innovate responsibly. That's how payments should evolve. Public trust, private innovation, shared benefits. Stablecoins flip that model, privatizing money control while socializing risks. So, are stablecoins the future of money or just another bubble? They promise inclusion and speed, but may deliver fragility and dependency. Even if every token is backed today, market pressures could lead to shortcuts tomorrow. The same moral hazards that caused past financial crises could resurface, hidden behind code. Tyrrell reminds us that finance is about trust, not just efficiency. Trust can't be outsourced to algorithms or private interests. It's built on transparency. Stablecoins may shine like innovation, but they rest on an illusion, stability from speculation. In the end, the story of stablecoins is about the line between public good and private gain. If payments become a playground for speculation, society bears the risk when it collapses. But if we treat payments as a shared utility, innovation can thrive on safer ground. So, will we build the future of money on trust or on tokens?